right? So I wouldn't worry about running fibs again if we didn't get the confirmation going up, right? I just run the fibs to project where we going, you know what I'm saying, once we already going, and then start consolidating. That's the purpose of the fibs. The I don't want anybody to get dependent on the tools. It ain't the tools just help us visually see the price action, right? Because when I'm selling, or when I ain't gonna say when we're buying, right? When we're buying, right? When we're buying this fair value gap right there, right? When we got dog it Tim. When we're buying that fair value gap right here, that blue box, the algos have no clue that that blue box is on our chart. Could care less, right? The algos could care less that we ran a fib from here up to that 15-minute order block and said, okay, the price gonna potentially go up here. The algos care less. So I used to, when I first started trading, I was highly dependent on the tools. I was highly dependent on fibs. That's why I don't trade OTE no more, because I was so dependent on the fibs that I would pick a low and a high, run the fibs, and if it hit 62 or 70, I was buying or selling, because I would just pick any low, any high, run the fibs, and if it hit that, ICT said if it hit this retracement, it's supposed to bounce without even having any thought process behind the price action. You know what I'm saying? We just got to figure out where price is trying to get and then use the tools to help us visually see it, because Robinson probably got a computer brain in his Chrome dome, and where he can look at this low and say, okay, that low is at 39.62, right? And then run some mathematical equation to say, okay, I need to set a reminder right here at, let me go to this 15-minute candles. I need to set a reminder right here at 39.62, 39.92.75, so that I'll know that that's the midpoint between where I want to go all the way up here at 40.24.25. Like, I can't do that. I can't look and be like, okay, take this number with this number, gonna give me this number. I can't do that. I'm not a computer. So I look at the clues that the algorithms leave, like it likes to consolidate at fair value. And what is fair value? Equilibrium. It likes to consolidate at equilibrium. It loves to do it. It does it all the time, right? And that's how I try to get in sync with the algos, by saying, hey, look, we're consolidating here for a long time. Let me go to, we're going up and we're consolidating. Let me go to the low prior to this consolidation and figure out where we can possibly be going. Depending on the time frame you're doing it on, you may get there today, you may get there tomorrow, you may get there next month. Because it take, like, if these were daily candles, this would be a really long time, right? We would have came up 1, 2, 3, 4, 5 days, consolidated for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 more days, and then went up for 1, 2, 3, 4, 5, 6, 7, 8, 9 more days before hitting our target. If these were daily candles, that's a really long time. I'm pretty sure that's more than a month. I wasn't keeping up, but I'm pretty sure that's more than a month, right? So try not to, I done got so far down the rabbit hole, I'm lost right now, but try not to worry so much about the tools as to why am I reaching for this tool. If you going on a construction site, right, and you need to cut a 2x4, you can use a handsaw, you can use a jigsaw, you can use a skill saw, you can use a saber saw, right? Timmy Rogers gonna reach for the saber saw because it's the most efficient. A handsaw, I'm gonna be forever. A jigsaw might break my bit. A skill saw, it's gonna cut quick, but it may not be straight. You know what I'm saying? But a saber saw, just throw it up there, pull it down, cut it quick. It's the most efficient. Why am I reaching for that tool? Because I want to cut this straight, cut it accurate, with the least amount of danger to me. This is the most efficient tool, right? Why am I reaching for that field? I'm reaching for that field because price started here, it moved to here, then consolidated. I'm reaching for the field to let me know where price can potentially go on this run, right? Take your fib, run your fib. Price can potentially come back up to these highs based off of where I just ran this fib, right? So this is a potential target for me, right? Come over here. Price consolidated here, and we left this area right here. All of this down here is a potential balanced price range, right? When we came back into the only inefficiency that's down here in this price range on this 15-minute time frame, we left with aggression, creating a order block off of this BISI, right? Took off. We know in hindsight it's a BISI after the next candle, but as soon as it created this order block, it cleared the high of that candle. You immediately drop down because this right here is giving you a hint that it's a balanced price range. The algos don't want to go back in that direction no more, at least not right now, because they gave you a clue, because they offered sell side, they offered buy side, they came back to the only inefficiency that was down here, and then they left with a purpose after consolidating, right? So this is another clue. It consolidated, so this is potentially halfway between where they're trying to get to. Clue number one. This is potentially halfway between where they're trying to get to, right? This is a potential balanced price range, because when they left this halfway point, they came to the only imbalance, inefficiency, whatever you want to call it, and then they left with aggression, right? When they left with aggression, they created this order block, right? So you extend that out in time because you broke the high of that order block. They let you know, I don't want to go back that way right now, right? Then you go down. Before you go down, you say, okay, boom, I see we broke the high of this candle. This candle's still working. It ain't got to close up there. It's still working. So you run that high out. You grab your fib, right? Why did you run that high out? They broke that high. This is an order block now. This is a potential order block now, right? Everything is potential. Nothing worked out. Potential order block. That's the high. Remember that, right? You can even go in and say, let me sit this here for a second. You can set the high, and then if you want to be, you know what I'm saying, extra like little Timmy Rogers, right? You come in here and set the mean threshold. We're just going to use that high of that candle right there to help us out, right? It looked close enough for government work, but you would measure out the body of that candle. So that's the high of the order block. It's the potential order block. This is the mean threshold of that order block right there. This is my line in the sand. If we break this mean threshold, I'm going to move to the side to see if we really want to be bullish or if we want to go bearish, right? You take your fibs, if I can find it, and run it up until your 50% gets in line with the consolidation. We're using the mean threshold of this big candle here, because it engulfs the whole consolidation range. It's one of the lowest bodies, it's one of the highest bodies, right? So we're going to use the mean threshold of that, where we're using the high of this candle to help us out. Now we see, okay, it's above those highs, so I can potentially use that high as a target, right? This right here can be low-hanging fruit, right? You can mark out where you want to shave off. This can be low-hanging fruit. You can start going in and making lines over there if you want to, right? You can plan all this out. Well, you want to plan all this out for real before you even get into the trade, right? This is low-hanging fruit. You know what I'm saying? That can be your ultimate target or your low-hanging fruit, right? I'm going to shave there, right? I'm going to shave here at this high. I'm going to take off 50% here.
Connection lost.
What you mean connection loss? I'm going to take off 50% here. I'm going to take off 80% here. Leave the last 20% to see if I reach my target. When I get to the 80%, I'm going to roll my stop loss from down here below this low up here to at my first shave point, right? Map all that out in your head before you get in there, right? But why did you grab this tool? Because I think I see that price is trying to get up here. It's consolidating here. That's halfway, potentially halfway. This is a balanced price range, because it's potential balanced price range, because when we came back to the only imbalance, we left with authority. We created this order block. That's the high that it broke. This is the mean threshold of the order block. That's my line in the sand, right? I grabbed this tool to show me where it can potentially go. That's why I grabbed that tool. I'm not relying on the field. It matters not if I connected it to this low because I thought the low was pretty. It matters that I connected to that low because that low was the start of this run, and now we're consolidating, and this is the potential half point. That is the lowest point of this price leg. That's why I connected it to that low. That's why, and the fib is the most efficient tool to tell me where we can potentially go for little Timmy Rogers. Now that we got all of that, all this is going through your head in like, you know what I'm saying, 30 to 45 seconds. Now we're dropping down to our next time frame, right? The clock is still ticking, right? The clock is still ticking. We done broke through. We got us a 5-minute fair value gap right here, right? We take our entry right there, ignore the fib. The fib is gone now. We're not using that no more, right? So now we're looking. This is our high of our order block. This is our line in the sand. Now that we've dropped to the lower time frame, you can even refine it. You can say, okay, this is the line in the sand on the 15-minute, but we got a 5-minute order block. So I want my line in the sand to be the 5-minute order block, because we may potentially come down to the 5-minute order block to test that, right? Because it's order block, right? This is the fair value gap I want to enter in on. You mark out the 5-minute fair value gap. The algos have no clue that you put that box there. But the reason why you put that box there is because when we left this area, we left with authority, right? Set an order block. Got a break in market structure right there. This is the only inefficiency in this area. So you're entering on the only inefficiency in this area. Right? If you had 2 fair value gaps, you choose which one you want to enter by looking at the price action to see, did we make a breakaway gap and then form another fair, like here. If we would have took off here and left a fair value gap there, and immediately after that fair value gap, we made this fair value gap, you can assume that this bottom fair value gap is going to be a breakaway gap, and they probably won't go back to it, and you can enter off of the top fair value gap. And if they go down to the other fair value gap, you can add to it by taking institutional order flow entry drill if it pokes into the fair value gap and comes back out. But that's how you pick which order block you want to use, right? You look at the price action and say, okay, this is a potential breakaway gap, so I'm just going to go in on this one. Or you can just hold and wait to see if it come back to get you. And if you be like, okay, it didn't come back to me to get me there, now we done made another order block here. So when we coming back down, right, I'm going to take it off this fair value gap again because we left an order block there. It has nothing to do with the drawings on the screen. It's all about reading the candles and trying to get the best entry based off reading the candles. And I said a whole lot of stuff, and that was all because it's not about, because she asked about running the fibs if we didn't get the confirmation. I wouldn't run the fibs in this instance because there's no need to run the fibs in this instance for the downside. The only way I would run fibs to figure out where to run it for the downside is if we, like, just take this for example, right? This for example, we didn't know, I don't know this is going to reverse right there. I would take fibs and run it from here and put the 50% down there. You know what I'm saying? To say, okay, we can potentially keep going down, right? That's why I would run fibs here. We can potentially keep going down, right? If I thought we can possibly keep going down, right? But that's just a possible target. If we break market structure back up, that's off the table. That's off the table. Now I'm looking for a reason to go long right here. Now, the next time it's time to pull out fibs is after we done went for a long time like this right here, and now we're consolidating again. Now I could pull out fibs and be like, hey, I never got a trade opportunity in here. Let's see if there's more legs left on this run. Then you will run the fibs again. Hopefully all that babbling helps somebody. Hopefully all that babbling helps somebody, because I talked a lot just then.